Video is over the basic concepts of capital structure. I'm your professor, Dr. Stephen Haggard. Oftentimes, when we talk about capital structure, we end up talking about dessert. Well, not quite dessert in the way you think of it, but at least a pie. So what is the capital structure question? The capital structure question is whether the mix of debt and equity that we use to finance the firm can create additional value. In other words, does it make sense for us to have more debt in our capital structure because it makes the overall firm worth more? And so we start talking about the pie theory. And what we're really talking about here is the whole value of the company. And the value of the company is equal to the market value of its bonds plus the market value of its shares. And so bonds would be debt and shares would be equity. So the goal of financial management, if that goal is to make the firm as valuable as possible, then the firm should pick the debt to equity ratio that makes the pie as big as possible. Now, some of you are thinking, but I remember the goal of financial management is to maximize shareholder wealth. You're correct, but stick with me just for a minute and we'll see that that is exactly where we end up after finishing this discussion. So let's talk about maximizing the firm value versus maximizing stockholder interests. So there are two important questions. The first one is, why should stockholders care about maximizing firm value? After all, firm value is a combination of both stock and bonds. And stockholders, because they are rational human beings, don't really care what's going on with the bondholders. They care what's happening to them. And so we think maybe they should be interested in strategies that maximize shareholder value. And so the big question is, what is the ratio of debt to equity that maximizes shareholder value? As it turns out, we can benefit the stockholder by making changes to the capital structure if and only if the value of the firm increases. Remember that equity holders are residual claimants, and so when the value of the firm increases, the equity holders are always the recipients of that increase. Conversely, when it decreases, they are always the sufferers of that decrease in value to the point that the firm declares bankruptcy, at which point the bondholders may also feel pain. Let's talk about financial leverage and firm value by working a very simple example. Consider an all-equity firm that is considering going into debt. Now, why would they do this? Well, maybe some of the original shareholders want to cash out, and the other shareholders don't have the money to buy them out and want to maintain their control of the firm. And so it makes sense for the firm to take on some debt to buy out those original shareholders. In fact, my sister is involved in a transaction like this right now, where she is buying out a firm because the people want to retire, and in order to do that, the firm is taking on debt to buy out those people that want to retire. So here we go. Let's talk about our current situation. We have $20,000 in assets. We have $0 in debt. That means that all $20,000 in assets must be financed with equity. And so this would have a debt to equity ratio of 0, because 0 over 20,000 is 0. Now, it's not useful at this point to talk about an interest rate because we don't have any money borrowed at all. We've got 400 shares outstanding at a share price of $50 a piece. Notice that 400 times 50 gives us 20,000, which we said was the value of our equity. It has to be like that or we've done something wrong. Now let's talk about the proposed firm. We're still going to have $20,000 in assets, so we're not buying anything or selling anything from an asset perspective. But now we are going to take on $8,000 in debt and use that money to purchase back $8,000 worth of shares. And so now we're only going to have $12,000 in equity. And we've got $8,000 in debt, so our debt to equity ratio will now be 2/3. Our interest rate, since we have debt now, we're very interested to know our interest rate is 8%. And our shares outstanding are 240. Now, how do we get that number? Do you remember that $12,000 in equity? Divide that by $50 per share, and that will give you your 240 shares outstanding after we take on debt. So let's talk about the earnings per share and the return on equity under the current structure. And we're going to look in 3 different phases of the economy. There is recession, expected, and expansion. Recession has a technical definition that is 2 or more consecutive quarters of negative growth in the gross domestic product of a country. And so that is our definition of recession. The others up here do not really have definitions, except for we can think of expected as being what we would consider to be normal, and expansion to be what we would consider to be a boom or growth time. The earnings before interest and taxes is $1,000 in a recession, $2,000 in normal times, and $3,000 in an expansion. That would tell us that this business is pro-cyclical. When the business cycle is on the upswing, so is the profit at the firm. Now, since we are unlevered at present, there is no interest whatsoever. And so all of that earnings before interest and taxes flows to net income. Now, we're making the assumption here of no taxes. We will relax that assumption later on. But for the sake of argument right now, we are just avoiding taxes. Okay, so how do we get our earnings per share? Well, remember, our current shares outstanding at the beginning is 400. So all I have to do is take the net income and divide by 400 to get my earnings per share. And when I do that, I get $2.50 in recession, $5 during normal or expected times, and $7.50 during expansion or boom times. And now we can take those EPS figures, or we could take the net income and divide by the value of the equity, which in this case is the value of the firm, in order to get our ROA, which is just net income divided by total assets. Net income of $1,000 divided by total assets of $20,000 from earlier gives us 5%. In expected times, we've got $2,000 in net income divided by $20,000 in assets gives us 10%. And in expansion, we have $3,000 divided by $20,000 or 15%. Now, since there is no leverage in our capital structure at all, the ROE is going to be exactly the same as ROA. This is because total assets equals total equity plus total debt. And total debt here is 0, so total assets must equal total equity. Let's take a look at under the proposed structure what we'd be expecting. Once again, the earnings before interest and taxes are exactly as we saw before. So the business hasn't changed any. It's only how we finance the business that has changed. We know we're going to have $640 in interest. $640 is 8% times the $8,000 in debt we take on. So that's why it's $640 per year. Now I want you to notice something about the nature of interest. Interest is a fixed cost form of financing. What do we mean by that? We are going to pay $640 for that $8,000 we borrowed each and every year, whether it's bad times, okay times, or great times. And so that's why we say debt is a fixed cost form of financing. Now by ignoring taxes, we can now find our net income. In recession, it's 360. In the expected or normal times, it's 1,360. And during an expansion, it's 2,360. And so now we can calculate the things below. Earnings per share would be 360 divided by 240 shares. Now why are we dividing by 240? Because we repurchased 160 shares by using that $8,000 that was borrowed. And so we've got 360 divided by 240 gives us $1.50 earnings per share. Now if we take 360 and divide by 20,000, the total assets of the firm, that gives us an ROA of 1.8%. And if you recall in our previous example, it was 5%. But now it's only 1.8%. So now we're starting to see perhaps a downside to leveraging up. In expected times, the ROA will be 6.8% as opposed to 10% in the unleveraged state. And in expansion, we will see 11.8%, or 2,360 divided by 20,000. And that is compared to 15%. Now notice that that is all lower. And that's because we are paying out interest before we get to our net income line. So our net income is lower. Why would we do that? Well, the answer has to do with who we're managing the firm for. We're managing the firm for the shareholders. So the number we should truly be looking at is ROE. And two things have changed here. Not only has our net income changed, but the total equity of the firm has changed because we've repurchased $8,000 in shares using that borrowed money. Now there is only $12,000 in total equity. And so 360 divided by 12,000 gives us an ROE of 3%. Now, once again, notice that is lower than the ROE in recession in the unlevered structure. However, when we move up to the expected range, we have an ROE of 11.3%. Why is that higher? Now we're starting to see the benefits of leverage. Where it was 10% previously, now it's 11.3%. And if we really want to see some good times, we just go to expansion and we've got 2,360 in net income divided by 12,000 in equity gives us ROE of 19.7. So in conclusion, we have higher returns in 2 of the 3 states. And so you might be asking at this point, which should we choose? And it would come down to the probability you would assign to each of these things. If you have a very high probability of recession, then you might not want to lever up your capital structure because you would have a lower ROE. However, if the combination of the probabilities of expected and expansion are greater than that for recession, you might want to consider levering up your capital structure in order to take advantage of these higher ROEs. Here's a nice graphic representation showing how financial leverage is impacting our EPS. And so we notice here that the red line represents the earnings per share as we increase our EBIT. I want you to notice a couple of things. This line never is negative within the realm that we're looking at here. Now, it is of course possible that we would have negative EBIT at some point. However, It's going to be way over here before that thing goes negative. Okay, now what happens if we throw in debt? Well, now we have, if we look up here, let's start at 3,000 EBIT. We're doing much better by having debt. In fact, we do much better having debt right up until we hit this point here, where we are indifferent between being levered or unlevered. And then we start to be worse off with debt. Remember that in recession, we were doing worse having debt than no debt? Well, that's what's going on here. And one more thing to notice is that the slope of this line with debt is higher. And so this is your EPS per dollar of EBIT is higher when you have debt. But that also means that when your EBIT goes down, your EPS goes down faster too. And so you have to be careful. Debt brings with it both rewards and risks. So what are the assumptions of the Modigliani and Miller model? By the way, no American will ever be able to say Modigliani's name correctly. Most of the time you people hear people pronounce it Modigliani. And in fact, that's how I pronounced it until I went to doctoral school and my office mate was an Italian opera singer and chemist, and among other things. And he told me it was pronounced Modigliani. And I said, Modigliani? And he said, no, you're saying it all wrong. It's Modigliani. So apparently there's this thing that Americans can't say or hear that has to do with this name. So we'll just call him Modigliani. The other M's pretty simple. It's Miller. So it's Modigliani and Miller. Or you could just say M and M. The first assumption is homogeneous expectations. What does homogeneous mean? It means all the same. It means that all of us have the same expectation of what's going to happen in the future. We have the same probability assessments for recession expected times and for boom times, and we have basically the same expectations across the board. Now, is that a realistic assumption? Absolutely not. You can have two people in a conversation and within 5 minutes you'll understand that they do not have homogeneous expectations. And then we have the assumption of homogeneous business risk classes. Firms would be in the same business risk class if their earnings were exposed to identical risks and behaved identically. So a homogeneous business risk class, we would assume that all automakers are exposed to similar risks and experience similar outcomes. And that's one of the assumptions of the M&M model, is that different firms in the same industry are exposed to the same risks. Then we have the assumption of perpetual cash flows. Just in case you're not familiar with this term perpetual, it means goes on forever. And perpetual cash flows might sound like a crazy assumption, but in theory, the corporation can go on forever. And unless it goes bankrupt or the owners just decide to sell the assets and close up shop, it will. And so that's why we can make this perpetual cash flow assumption. And then we have the perfect capital market assumptions. The first is that there is perfect competition. The second is that firms and investors can borrow and lend at the same rate. And at first that might sound a little crazy, but in fact, businesses actually pay more for debt than investors. Here's why. Businesses tend to be borrowing against specific collateral or cash flows. It's undiversified, and there's no mechanism to immediately get your money back as a lender if the business starts to have trouble. However, the way that investors borrow is through something called margin. And in a margin account, your broker is the lender. And if you look like you're going to be in trouble, all the broker does is sells some of your stock to repay themselves. In other words, eliminating their own risk in the loan for the great majority of risks. In fact, the markets would have to go to zero almost instantaneously for your broker to be exposed to risk. As a result, investors can borrow for very nearly the risk-free rate. But that can't be said about businesses. Then we have the assumption of equal access to all relevant information. This one is a little harder for people to buy into because we know that insiders have more information than outsiders, and that perhaps the equity holders who've been with the company for a while might have more information about the firm than a potential new bond holder. But still, under this M&M model, we are assuming equal access to all relevant information. Another way to say that would be no information asymmetry. We would also have the assumption of no transactions costs. And even those of you who are using Robinhood or myself using Charles Schwab, you might think that we have no transactions costs, but that's not true because of the bid-ask spread. And so this is another assumption of the M&M model that we know we'll have to relax later. And then finally, the biggest fantasy of all is that there are no taxes. There are taxes in every country of the world. Now, I've had Saudi Arabian students before who tell me there are no taxes in Saudi Arabia for Saudi Arabians. And then I ask, are you expected to pay charity? And they said, yes. And basically, this charity that they are expected to pay is treated very much like tax. If they don't pay it, then they will have some legal consequences. And so please don't argue that your country has no taxes. Every country has taxes. We just call them something different. So one of the ways that Modigliani and Miller seek to establish capital structure irrelevancy, meaning that there's no way the firm can create or destroy value through their capital structure decisions, is to demonstrate the concept of homemade leverage. Homemade leverage says that I can buy the shares of an unlevered firm and create my own levered investment in my own account. And so let's say that I wanted to own shares in a levered firm, but the only firm available was unlevered. What could I do? So in this example, here we are looking at basically buying 10% of the firm. So we're going to buy 40 shares of this $50 stock using $800 in margin, which is the debt in our brokerage account. So I'm going to show to you that we get the same ROE from this investment that we would get if we invested in the levered firm. So how does this work? Well, we've got our 40 shares, and we're going to multiply by $2.50 in Recession, and that's going to give us $100 in earnings. And then we must pay the interest on the debt in our margin account. 8% of 800 is $64, and that leaves us with net profits of 36. When I divide that 36 by my original investment, I get 3% ROE. So, how much equity do I have? 40 times 50 is 2,000, minus the 800 that I owe gives me 1,200. So I have 1,200 equity in my account. And so when I divide 36 by 1,200, I get 3%. In expected times, I will get $5 per share from my 40 shares, which will be $200. But I have to pay $64 in interest. So we're going to say 200 minus 64 is 136. 136 divided by 1,200 gives us 11.3%. And finally, in expansion,
for each of those 40 shares, I'm going to be getting $7.50, which gives me $300. But I must pay $64 in interest because of the fixed cost of debt financing, and that leaves me with $236 in net profits. Now, 236 divided by 1,200 is 19.7%. Now, if you will note, these ROEs are identical to the ROEs of the levered firm. And so we have completely been able to replicate the pattern of cash flows that comes from owning the shares of a levered firm simply by creating leverage in our own account, buying the unlevered firm and then buying more of it with borrowed money. So what is our personal debt to equity ratio here? We owe $800 and we have $1,200 in our own equity in the account. And so that is 2/3. And it turns out that is exactly the same as the debt to equity ratio was for the levered firm. Now you might ask, wait a minute, what if we don't want a levered firm? What could we do? Well, it turns out we can undo leverage in our account. So what are we going to do here? In this case, we are going to buy 24 shares of the levered firm, and we are going to buy, oh, by the way, 24 shares. That is 10% of the shares for the levered firm, because remember, they bought back some shares. And so we're going to buy 24 shares, multiplied by $1.50, that gives us $36 in earnings. Now this time we are going to buy 10% of the firm's debt. And when we do that, we're going to receive the interest instead of paying it. And so 36 plus 64 is 100. 100 divided by our total $2,000 investment gives us a return of 5%. We can look at the expected and expansion situations and see that we will get ROEs of 10% and 15%. And if you look back at our unlevered firm, these are exactly the same ROEs that we saw for the unlevered firm. And so we have successfully undone the results of leverage here simply by buying both the stocks and the bonds of the levered firm. So this is one of the fundamental insights of Modigliani and Miller, and that is that firms can't magically create value simply by messing around with their capital structure. Now keep in mind that at this point in the game, we are assuming that there are no taxes. Once we get taxes involved, things start to get a little more complicated.
So we can state M&M Proposition 1, no taxes. We can create levered or unlevered positions by adjusting trading in our own account. In other words, we don't need the corporation to do this for us. This homemade leverage tells us that capital structure is irrelevant for the value of the firm. In other words, the value of a levered firm is equal to the value of the unlevered firm. Now keep in mind, one of our key assumptions here is that the company and the investor can borrow on the same terms. And we know that investors can get at least as good a deal as companies when it comes to borrowing money. So now we are on to Modigliani and Miller Proposition 2, still not considering taxes. And here's Proposition 2. Leverage increases the risk and return to stockholders. Now this makes sense. We know that risk and reward must go together. And so we've got this formula here, and let's talk about what all these different things are. R sub B is the interest rate, or the cost of debt. In fact, the B stands for bond. R sub S is the return on the levered equity, also known as the cost of equity. We might consider this to be the expected required return on the shares. R sub 0 is the return on the unlevered equity, also known as the firm's capital. If the firm were totally financed with equity, this would purely represent the underlying risk of the firm itself, and so that is what R sub 0 is based on. Of course, B is the value of debt, and S is the market value of equity. By the way, in these formulas, we are always talking about market values, not book values. If you want to find out what's going on in the real world, you always want to use market values. Book values are nice for accountants. They help us to determine our taxes. They help us to determine after-tax salvage values and such. But when we are trying to figure out what our true required return is, we definitely need to use market values, not book values. So here is a graphical representation of Modigliani and Miller, Proposition 2 with no taxes. In the vertical, we have the cost of capital, and in the horizontal, we have the debt-to-equity ratio. Now let's look here. We see that R sub B, or the required cost of debt, is assumed to stay the same over the entire range of debt to equity. Now this is a kind of a shaky assumption, because if a borrower has more debt, wouldn't you require a higher return from them? But we'll go with this assumption for now. And then we have the overall risk of the firm. This would be the risk of the unlevered equity. You may be familiar with it from earlier classes, being called the weighted average cost of capital. Now keep in mind, we're in a world with no taxes, and so there's no 1 minus T sub C term in here. But other than that, this is exactly the same formula you've seen before. And keep in mind, we often refer to the RWACC as the cost of capital for the firm. That is based on the underlying assets of the firm. And if the firm was 100% equity, the B would be 0, and so this whole term would go away, this would go away, and we would end up with just the required return on the stock in that situation. Now, what is the impact of leverage on the required return of stock? Well, we see if we go all the way back here where there is 0 debt to equity, it makes perfect sense that it is exactly the same as the unlevered equity, which we said was R sub S. And so there's no surprise there. But as we add debt, we end up with this situation. We're going to take the required return on the stock if there were no leverage and subtract out the required return on the bonds, and then we're going to multiply that by the debt to equity ratio and add that to the required return on the unlevered equity, and that's going to give us the required return on the leveraged stock. And we can see as we increase here that the required return on the stock goes up in a linear fashion. In other words, the more debt I take on, the riskier the firm's equity is, and the higher return investors will demand for holding that stock. Okay, now we're going to throw taxes into the picture and see what happens. Now we're going to restate Proposition 1, including corporate taxes. And now we can see that firm value increases with leverage. Why would this be the case? Well, it turns out that interest is tax deductible. And so if you pay $1 in interest, it reduces your taxable income by $1. Let's say your tax rate was 21%. Each dollar of debt, each dollar of interest saves you 21 cents in taxes. So that's the tax shield of debt. Now keep in mind that the value of a firm is the present value of the future cash flows discounted at a rate appropriate to the risk of those cash flows. And so the value of the unlevered firm is representative of all the dividends, present value of all the future dividends. But when we start throwing in this additional tax shield of debt, we have to find the present value of that. Well, something that we're not seeing here on this formula, T sub C times B. By the way, T sub C is the corporate tax rate. One of the things we're not seeing is that on top there's actually a multiplied by the required return on bonds. Now, so the amount of bonds times the required amount of return on bonds gives us the annual or period amount of interest that has to be paid, and then we're going to multiply that by T sub C to get that tax shield. That gives us the value of the tax shield in future years, but we need to find the present value of it. And assuming this is a perpetuity, the way that we would do that is to divide by R sub B, because that is a rate that is appropriate to the risk of those particular cash flows. Now, in essence, what ends up happening is those R sub B's end up canceling out. And so this is why T sub C times B is the present value of the tax shield that we get from debt. Okay, so let's talk about Proposition 2 with corporate taxes. Some of the increase in equity risk and return is offset by that interest rate, by the interest tax shield. And this formula looks identical to what we saw earlier with one change. Now, this add-on for debt is actually multiplied by 1 minus T sub C. And so we can see that as the tax rate goes up, the required return on the stock will go down because there's a greater interest rate tax shield.
So now let's look at the impact of taxes on our situation for firm value with financial leverage. So on the vertical axis we have returns, and on the horizontal axis we have the debt to equity ratio. And we can see that as the debt to equity ratio goes up, we've actually seen this line at the very top, the required return on the stock, must go up as the debt to equity ratio increases. Now, one of the strange assumptions here is that the required return on the bonds would stay the same regardless of the debt to equity ratio. Of course, if someone with more debt wants to borrow money, you're going to charge them a higher rate because they are at a greater risk of default because they have more debt. Where this really starts to get interesting is to look at the required return on the stock when we include taxes. Now, we are basically multiplying by 1 minus T sub C for this second term. Hang on, let me turn on the laser pointer. There we go. So now we're going to add in this 1 minus T sub C because the cost of that debt is tax deductible. As a result, that is going to lower the required return on our stock. Another impact that we see here is with the weighted average cost of capital. Previously, this was a straight horizontal line. It was unaffected by the debt to equity ratio, and if you remember, this was the same as the unlevered equity required return. If we have a zero debt to equity ratio, that's still true. But now, as we come out here, this thing starts to decline at a decreasing rate. And the reason it's doing that is because we are having to multiply by 1 minus T sub C. And so this thing actually goes down. And so it's cheaper to finance our firm with debt now, simply because that debt is tax deductible. And so this is why we see that the assumption of no taxes is not a good one, because taxes are what creates the ability to create value for your shareholders through leverage. Now this tells us that capital structure is not irrelevant. Let's look at the total cash flow to investors. Remember that people invest in order to be able to get cash flows. Well, which firm is going to give them greater cash flows? Is it going to be the equity firm or the levered firm? Well, at first you might say, wait a minute, the levered firm, they've got to pay interest, so it has to be the all-equity firm. But that's not true. So look at the all-equity firm. In recession, they have $1,000 earnings before taxes, and they have to pay $210 worth of taxes, so then that's $790 in cash they can pass on to the shareholders. But look at the levered firm. They have the same $1,000 in earnings before interest and taxes. We subtract out the interest of $640, and now they've got earnings before taxes of $360. So they're only going to pay taxes on $360 instead of $1,000, and so those taxes are only $75.6. And so when we add together the total cash flow from the bonds and the shares, we get $924.40. And so $924.40, those cash flows that are coming out of the firm to the investors, debt and equity, are greater than the cash flows that are coming out in the all-equity situation. And we can see the same thing in the other two states of the economy. In both cases, because of the reduction in taxes, we see a greater cash flow to the investors, both bondholders and shareholders, for the levered firm than we would see for the all-equity firm. And so this is yet another proof that capital structure is not irrelevant. So how does this work? Well, keep in mind that the firm is producing a certain amount of cash flow. And for the all-equity firm, those cash flows are flowing only to the shareholders and the government. In the levered firm, they are flowing to the shareholders, the debt holders, and the government. However, the government is taking a smaller piece now. And so the cash flows to the debt and equity holders added together in the levered firm are greater than the cash flows to the equity holders in the all-equity firm, because the pie is the same size, but the government is just taking a smaller slice. So let's summarize what we've been talking about here. Let's talk about the world of no taxes. So in the world of no taxes, the value of the firm is not affected by the capital structure. This is what we refer to as capital structure irrelevance. And so that's what we talk about as Modigliani and Miller proposition number 1, that the value of the levered firm is identical to the value of the unlevered firm. Proposition 1 holds because shareholders can achieve any pattern of payouts they desire with homemade leverage. Remember that we showed that you could make a levered company look like an unlevered company by buying both the shares and the bonds, and we could make an unlevered company look like a levered company simply by purchasing shares on margin, which is debt. In a world of no taxes, Modigliani and Miller proposition 2 states that leverage increases the risk and return to stockholders in proportion, resulting to no change in the net value of the firm. You'll hear people say we should finance the firm but with debt, because debt has a lower required return than stock. That might be true, but what they're failing to understand is that the required return on their stock will go up the more debt they take on. And the overall cost of capital for the firm will not change in a world without taxes, simply because of the change in the capital structure. When we start looking at taxes, it's a little different. Now, we're in a world of taxes, but there are no bankruptcy costs. And so the value of this firm is actually going to increase with leverage. And the reason that it does is because of the tax shield of debt. And so we have to restate Modigliani and Miller's Proposition 1 by saying that the value of the levered firm is equal to the value of the unlevered firm plus the present value of that perpetuity of tax shield going forward. So this is the amount of taxes that we'll be saving every year. T sub C times B times R sub B is the amount of taxes we'll be saving every year. And then to find out the present value of that, since it's a perpetuity, we're going to divide by R sub B, which is the required return on these cash flows. And so the R sub B will cancel out, leaving us with this formula. And so in this case, as the value, or as the leverage of the firm increases, so does its value. In a world of taxes, Modigliani and Miller Proposition 2 states that leverage increases the risk and return to shareholders. But notice this, now that we are throwing in this tax term, as tax rates go up, then the required return on the stock actually goes down because of the greater tax shield provided by debt.